Hi, Greg Dorsey here. It's Monday, September 27th at Leeb.com, Leeb.com. Well, stocks took a breather today after last week's good, strong gains when blue chips, measured by the Dow Industrials and the S&P 500, were up about 2%. The NASDAQ 100 was up 3.5%. Small caps, on the other hand, using the NYSE's unweighted average, were up a more muted 1.6%. Several aspects in the action has been, and I'm not talking about just today, but over the past week, is really worth mentioning. Ideally, you want to see small cap stocks outperforming the blue chips, not the other way, the way we've seen it. The trading really has been largely driven by a handful of stocks. In a similar vein, when stocks have risen for 4 consecutive weeks, gaining, call it about 8% or so. Yet in the last 3 weeks, the number of stocks advancing on the NYSE have outpaced declining issues by really a rather small margin of 1.6 to 1. Given a healthy advance, we would expect at least 2 to 1 and ideally much higher than that to reflect a healthy move. We're just not getting that. Let's look at an individual stock as an example. Offering an illustration of what's going on here, and that's Apple Computer, which has become the second largest stock out there. The stock has gained about 40% in the past this year to date, on the strength of this must-have electronic devices such as the iPhone 4 and of course the iPad. As a result of the move, the stock has accounted for, and it represents about 20% of the NASDAQ 100, and it has accounted for nearly all of the 9% gain in that index this year. We like the company and its products, but that stock alone isn't enough to drive a sustainable rally. And there's really just a handful of stocks like that that are powering things. Another worrisome aspect of the trading is the lack of volume on the big board, which last week was less than 5 billion shares. We want to see a pickup in that volume when stocks advance. Instead, what we continue to see is that when stocks decline, the volume picks up. When stocks advance, the volume dries up. That's a sign of distribution, not accumulation. We've been bemoaning this development for some time now, though, as we've also pointed out in the past, in and of itself, that's not going to trigger a correction. In other words, the light volume is a symptom, not a cause of the poor quality of the rally. Stocks aren't the only asset that are rising right now. We're experiencing strong up moves in bonds and precious metals. The moves are occurring as the U.S. dollar continues to tumble. Something that could continue with the market now pricing in a possible massive round of quantitative easing, probably on the order of $1 trillion or more by the Federal Reserve sometime in the next several months. As a result, while we're concerned with the quality of the rally in equities and the concurrent rally in bonds, we're not inclined to sell stocks short here. The momentum is just too strong to stand in the way without risking getting flattened in the process. But at some point, we'll have to pay the piper. We don't know when that is, but sometime down the road, we are going to pay a stiff price for it. That's all for now. Thanks for stopping by, and we'll see you again soon.